The Fed did not hike, but the projections still changed the trade. Welcome back to this week's market recap. This week's market is dealing with a quiet hold that carried a hawkish message. The mechanism is simple. Higher inflation projections and a higher rate path squeeze cut hopes, even when the index close looked strong. Oil relief gave buyers room, but the Fed took some of that room back. I think buyers still have the first shot, but they need yields and inflation expectations to calm down fast. Sellers need the Fed pressure to show up in price again, not just in headlines. Here is the tension I care about. The Fed held rates steady at 3.5 to 3.75, and the vote was 12-0, so the decision itself was not the shock. That unanimous hold matters because it tells me the Fed was not ready to force a hike right now. But the 2026 projection moved up from 3.4 to 3.8, and the 2027 and 2028 paths moved higher too, so the rate path became less friendly. The chart is the problem for traders, because a quiet hold still turned into a higher projected path across the next 3 years. Inflation made that message harder to ignore, with the 2026 PCE projection up to 3.6 and core PCE up to 3.3, while the official objective stayed 2%. Retail sales added the second push, because May spending beat at 0.9% and showed the consumer was still spending. That combination squeezes cut hopes because demand is not breaking, inflation is not solved, and the Fed is giving traders less room to assume easy policy. For stocks, I read this as a rally that can still work, but only if yields cool and buyers prove the Fed reset is already priced. The Dow Jones Industrial Average barely moved higher, up about 70 points, and that tells me the rebound was not broad enough to call it full participation. The S&P 500 rose a little over 1%, so buyers did hold the broad market instead of giving back the Fed-driven pressure. The Nasdaq Composite jumped almost 2%, and that says growth in tech did most of the work in repairing the tape. VIX fell hard into the mid-teens, so fear backed off and gave buyers more room to defend the move. Bitcoin fell a little over 2%, so speculative demand did not fully join the equity rebound, and that keeps me from calling this a full risk chase. So the first test is SPY. Buyers need to hold the post-Fed rebound, and sellers need to prove the higher rate path can still break the broad market structure. SPY still gets the benefit of the broader uptrend, but this is not a place where I want to chase blindly after the Fed reset. The long-term chart is why I'm still giving buyers the first shot, because price has pushed above a major multi-decade channel structure. The breakout close is the big event here, with price trying to break out above the upper rail instead of rolling back under the old structure. The upper rail near 730 is the level I would be watching now, because holding above it keeps the move from looking like a one-day emotional reaction. Falling back inside is the risk that would change my tone, because that would turn this from a breakout attempt into a failed break. RSI gives us the stretch red first, and it says the market is extended, but not enough by itself to call a reversal. Let me quickly switch to MACD, because momentum matters more than stretch when price is trying to hold a breakout. MACD is still above zero and expanding, so the long-term momentum backdrop is confirming the upside attempt for now. On the active channel, I still think buyers have the better argument, but they have to prove it into the close, not just spike into resistance. Price is trading inside the rising channel and still sits in the upper half, so the structure has not turned defensive yet. RSI is back around the 50 line and turning up, so downside momentum is no longer clearly confirming a breakdown. The upper band near 754 is the control point for me. Holding that area keeps the trend in charge, while rejection opens a pullback toward the middle of the channel around 725. Daily range is tight relative to the channel, so I do not want to ignore the next expansion. When this breaks, it can travel quickly. The candle warning is the reason I am not calling this an easy breakout. After a long push higher, demand faded and price rejected enough to justify tighter stops on long exposure. My base case is still that the broader uptrend can survive, especially with the June 15th oil relief still helping risk appetite, but the Fed gave sellers a better excuse to test buyers. A break below the last bar low would be the clean warning that this pullback is getting heavier, while strength back above the last bar high weakens the rejection signal. The IYT to SPY ratio is the participation check underneath the S&P 500. On this chart, a rising line means transports are outperforming SPY, while a falling line means transports are lagging the index. For a healthier equity rally, bulls want that line rising or at least stabilizing, because that means transports are confirming the move instead of trailing it. That matters because shipping, rail, trucking, and logistics stocks tend to respond to real economy demand, so strong transports usually point to healthier cyclical breadth. Here, the message is more cautious. The ratio's PPO has crossed below its signal line while still above zero, so transport leadership may be starting to fade. That does not force SPY lower by itself, but it makes the advance less convincing unless buyers broaden the move. I still treat the uptrend as alive, but the next confirmation has to come from tech leadership, because a narrow rebound after a hawkish Fed reset is much easier to reject. QQQ is giving the market the leadership answer SPY needed. I still give buyers the edge here, because growth absorbed the Fed reset better than the Dow, and price is still holding the stronger part of the structure. The upper line matters because it is not a short reaction mark. It runs from February 2025 into this week, so repeated tests over more than a year make it a real resistance reference. The lower line is newer and faster, coming off the April low, so the trade is really about whether buyers can keep pressing toward the older ceiling without losing that fresh support. Let's move in a little closer. Price is above both major averages, and that keeps the recovery structure alive after the hawkish Fed reaction. The 50 days moving average has held for 51 sessions, so that is the first trend cushion if sellers try to cool this move. The 200 days moving average is still well below price, so the bigger Nasdaq structure is not the problem right now. The support line is the level that keeps this from turning into a failed rebound if the next pullback starts. The resistance line is the upside test, and I want to see buyers press into it without getting rejected right away. RSI is above 50 and rising, so short-term momentum still supports continuation rather than a breakdown. MACD is still slightly negative, but the histogram is improving, so selling pressure is cooling instead of accelerating. For me, this reinforces the broader bounce thesis, but it also sets up the next chapter if yields keep repricing higher. QQQ has less room for sloppy follow-through. The 10-year yield is the pressure point after QQQ. My read is that equities can still bounce. But that gets harder if TNX holds this channel and rotates higher again after the Fed reset. Price is inside the rising channel, but it is in the lower half now, so rate pressure is still alive but not fully accelerating. SMA 50 is the support test here, with price sitting near that rising 50 days area around 4.42. If that area holds, I would expect a rotation back toward the channel midline near 4.46 and possibly the upper band near 4.56. RSI has slipped below 50, so momentum is shifting towards sellers, and that gives stocks some breathing room for now. The problem is that the structure is tight, and when range expands from here, the move can travel quickly. So the equity bull case wants yields to lose the lower channel support, not just pause for a day. If TNX bounces from this area, the Fed path stays restrictive, growth loses room, and crude becomes the next inflation input to watch. Crude is where the macro pressure finally gave stocks some relief. After the TNX chapter, my read is simple. Lower oil helps the equity bounce because it cools the inflation impulse. But this chart is still not a clean bullish turn for crude. Price is below the 50 days moving average but still above the 200-day, so the short-term crude trend is soft while the bigger structure has not fully broken. The 50 days moving average is the first reclaim level, and until crude gets back above it, rallies can still get sold. The 200-day is the deeper line that keeps this from becoming a full trend failure yet. The support line is vulnerable here, and I still lean continuation lower before I trust an immediate bounce. The resistance line is the upside repair test if buyers do push crude back from this lower part of the structure. RSI is still below 50 and fading, so momentum has not repaired after the de-escalation drop. MACD is fading below zero, so crude still needs price confirmation before I call this a healthy bullish reversal. Volume overlay is the caution flag here, because the 5 days average volume sits in the bottom 20%, so participation is unusually light for this chart window. If support gives way, the next downside focus is around 61.86, and that would keep pressure off inflation expectations. If support holds and price pushes back up, the bearish oil read weakens quickly. But for equities, the cleaner message is still that cheaper crude gives Nvidia and the AI trade more room to lead the next chapter. Nvidia is back in focus because the AI infrastructure story kept getting fresh support while oil relief gave growth stocks room to breathe. HPE expanded its AI factory work with Nvidia during the week, and Nvidia also pushed more European AI infrastructure and manufacturing headlines. Traders also had financing and buyback headlines in the mix, so this was not just a passive rebound with the index. My read is that NVDA still supports the broader bounce case, but buyers have to hold this reclaim instead of giving it right back. Price is back above the key short-term area after the pullback, and that makes this look more like a correction being defended than a leadership failure. The 50 days moving average is right under price and acted as support today, so that is the line I care about first. The 200 days is still below as the broader trend floor, which keeps a bigger AI structure from turning defensive. The support line matters because price is still working in the lower half of the structure, so bulls need this area to keep holding. The resistance line is the next repair test, and a pushback toward that upper half would tell me the June 18th rebound has real follow-through. RSI has reclaimed 50, so momentum is shifting back toward buyers at the right spot. MACD is still slightly negative, but the histogram is improving, so selling pressure is cooling rather than accelerating. Volume overlay is the caution flag here because the 5 days average volume sits in the bottom 20%, so I still want stronger participation before calling this a full leadership reset. If the 50 days keeps holding, I think NVDA can help the market work back toward the upper part of the structure. A clean loss back below that line would weaken the bullish read quickly and put more pressure on Microsoft to prove megacap AI can still stabilize the tape. Microsoft had a messy AI capacity story this week. GitHub demand tied to AI coding was reportedly heavy enough that Microsoft leaned on outside cloud capacity, including Amazon support. There was also a reported Oracle capacity deal that did not move forward over security and compliance concerns. Add the shareholder lawsuit around Azure growth and Copilot claims, and the market is asking whether cloud AI spending is still strength or margin pressure. My read is that MSFT is not giving the market the same support that Nvidia gave in the last chapter. This is still a megacap stabilizer candidate, but the chart is making buyers prove it first. The long-term chart is the problem here because price has closed below an 8-year weekly log channel instead of holding the old growth structure. The breakout close is actually a downside break in this case, with price trying to break down below the lower rail. The lower rail near 4018 is the level I would be watching now because price is about 7% outside the channel and needs to reclaim fast. Falling back inside would weaken the bearish message quickly, and that reclaim would help the broader bounce case. RSI gives us the stretch read first, and it says downside pressure is real, but not a panic washout by itself. Let me quickly switch to MACD because the break needs momentum support before I treat it as fully confirmed. MACD is still above zero, but it is starting to shrink, so momentum is not fully confirming the downside break yet. Volume overlay matters here because the 5-week average volume is unusually strong, so I cannot dismiss this as a quiet shakeout. So MSFT pushes against the clean bounce thesis more than it supports it. If buyers reclaim the lower rail, the failed break path can repair megacap software. If they cannot, this cloud AI pressure rolls straight into the macro calendar risk next. Now the calendar is where this whole setup gets tested. After Microsoft showed stress inside megacap software, the market needs macro help, not another reason for yields to stay firm. Tuesday, June 23rd brings S&P Global Manufacturing PMI and S&P Global Services PMI, and I care about whether growth is steady without looking inflationary. Strong growth can help earnings confidence, but if it comes with the wrong inflation tone, yields can stay sensitive and growth stocks get less room. If those PMI numbers cool in a controlled way, buyers get a better argument that the economy is slowing enough to reduce Fed pressure without breaking demand. Thursday, June 25th is the bigger inflation checkpoint, with core PCE month over month and year over year. That is the Fed-sensitive print. A hot core PCE read keeps pressure on yields, squeezes cut hopes again, and makes the equity bounce harder to trust. If core PCE cools, buyers get more room, volatility can stay contained, and the broader uptrend has a better chance to keep working. So the two-path setup is simple. Steady growth plus cooler inflation helps buyers, while sticky inflation, firm yields, or weak demand keeps the retest risk alive into the next tape. The full market read is still bullish enough to respect, but not strong enough to chase blindly. Again, the market held the broader uptrend after a messy Fed reset, but the close now matters more than the intraday push. The overhead resistance cluster near 747 is the first line I care about, because price is close enough to press into it, but buyers still have to prove control there. Again, price can keep pushing higher, but I would not blindly chase it into that resistance zone without a firm close. RSI at 54.1 is not extreme, so the market is not washed out, and it is not overheated in a classic blow-off way. That helps the bullish argument, but it also means momentum still has to turn back up instead of drifting sideways. MACD is rolling over while still above the zero line, so the trend is not broken, but buyers have not fully repaired momentum yet. The market is not at an extreme inside the bands, and that keeps both paths alive instead of giving either side a free pass. The rising channel still gives this market a good structure, but good structure still needs confirmation. Last week, I told you the 745 area mattered, and now the market is proving why that zone was the right focus. Again, the macro driver does not replace the level. Oil relief helped buyers, but the hawkish Fed hold kept yields and rate expectations in the way. If that pressure stays active, the 747 area matters even more into the close, because buyers cannot just tag it and fade. From here, I'm moving this into the thesis map for the next tape, because the decision is no longer just direction. It is whether buyers can hold the right zone into the close. The path I would give the edge to is still controlled continuation, but only if buyers hold the breakout area and press back towards 747 without getting sold right away. The overhead resistance cluster near 747 is the line in the sand for that first push. If buyers hold that area into the close, the broader uptrend can keep working instead of turning this into a larger stall. Secondary resistance around 756.4 is the next supply test if the first resistance area gets absorbed cleanly. The 20-day swing high near 760.4 sits in that same upper zone, so I want stability there, not just a fast spike and fade. The larger upside objective would only start to come into view near the measured move target around 820 if buyers keep control through those resistance checks. Again, that target is not active just because it exists on the map. It needs a confirmed hold and follow through above resistance. If that fails, the cleaner risk path is a pullback first, with price cooling toward support before buyers get another real chance. The pullback support zone near 729 is the area I would watch if rejection starts to matter more than the breakout attempt. Support near 729 is not automatically bearish if buyers defend it cleanly. It can still be a corrective reset inside the larger trend. Again, as long as buyers keep holding the breakout structure around 747, I treat pullbacks as corrective first. The breakout structure around 747 is the level that changes the read if sellers take it back instead of letting buyers hold above it. Do buyers hold 747 and press towards 756, or do we cool off into 729 first? That is the whole decision into the next tape. That is the full weekly market recap for June 15th through June 18th. Watch whether buyers can hold the 747 area, respect the 729 support risk if the tape cools first, and let the close confirm the next move before chasing. Thanks for watching, stay sharp, and I will see you in the next market recap.